We now begin with the new chapter, chapter 8, Sources of Business Finance. If you want to start a business, you need finance. Finance we say in terms of our accounting as a capital. Without a capital, no businessman can start a business. So whatever the owner brings in business, that is cash or a furniture or a building or a land, or you can say the goods, whatever the owner brings in business, we used to call it as a capital. And that is what the finance for the sole proprietor and partnership. Now here in management, the business finance has a wider meaning. It has a broad concept. Business finance, it does not stick to the capital, that what a owner is bringing. You require a huge amount, so total amount cannot be brought in by owner. So you also need an additional capital, that is to be said that from borrowing the funds from the outsider. So the meaning from the business management point of view, we can say the meaning of business finance is that finance which in total you require, the total financial requirement, it may be covered from the owner's fund, that is your C, or may be covered from borrowed funds, that is what your liabilities. So the total for C plus L, the total figure what you say is a business finance in management terms. So now we are going to see that how the business finance can be collected by the big business houses, by the big business units. So business finance can be collected, one, from the owner's fund. So owner's fund can be collected maybe in the form of equity share, it may be in the form of preference share, it may be in the form of retained profit. What that retained profit means? The undistributed profit to the owners. You have kept certain portion aside. That is what called as a also plowing back of profit. So in this chapter we are going to study equity share, its meaning, characteristics, types. Then the preference share, again meaning, characteristics, types, advantages, limitations, and of retained earning, again meaning, characteristics, and its advantage and limitation. So these three are your owner's fund. Owner means the shareholder, are the owner of the company. So owner purchase equity share, owner purchase preference share. Here the equity shareholder are the real owner because they have the voting right and they have voice in management. Preference shareholder, they enjoy some preference, so they are owner but next to the equity. They have the certain priorities, so they are different type of owner. Retained earning, it is a owner's profit that is retained in the business. So again towards the ownership capital. Next is that is the borrowed funds. When the owner's funds are not sufficient, we have learned that authorized capital limit is there. You cannot issue shares more than that authorized capital. So when you need more funds, you have to open the another window, that is the borrowed funds. Now borrowed funds can be collected in the form of debenture. All the meaning of all these we will be learning later on. In the form of a bonds, the government normally issue, the public sector normally issue the bonds. Public deposit, you get money from the public in general in the form of a deposit. You get the loan from financial institution for the long-term purpose. You also utilize the commercial banks as a best source of finance for the short-term purpose, short requirements of finance you have. You are buying the goods on the credit, so the credit period, postponement of the payment, that postponement period is one kind of a source of finance, that is known as a trade credit. And you also get the internal corporate deposit. One company, that is the holding company, give support, financial support to the subsidiary company, or one company give financial support to the another company. So one corporate give finance to another corporate. That is your one kind of a source of finance. So all these are the borrowed. It's not your own. Temporarily you are asking and getting funds. So again, all these source, the meaning, its types, how you get the thing, all we will be learning in this chapter later on. This is just for an introduction, that what the meaning of business finance, which include owner's fund and borrowed fund, and what are the types of owner fund and borrowed fund. Now the next we see, that is the need of business finance. Why you need money? Why you require money? As you are doing a big business, you may have a variety of expenses and variety of things to be taken care of. So the need of finance, the total finance you have to calculate by keep in mind the following few factors. The very first factor, for establishment of business. If you start a business, you need to spend money. You have to go with the procedure of registration, incorporation. You have to go with the procedure of your commencement. So all these required a huge investment, huge expense, and even the time also you need for all this. So whatever the preliminary contracts you are going to undertake, at that time you need money. So this establishment expense you have to keep in mind. To start your business, what funds you will be in need. Plus, now business registration work is over. The very next question will come, to purchase the fixed asset. In your memorandum of association, you have to write the address clause. So when you write address, you must have to have that place occupied by you. It is going to be the head office of business, must be the own place. So address may not change here and there. So you need to purchase the asset. Fixed assets like land, machinery, building, the premise, the other fixed assets. All these assets, find out the total figure, how much you require to buy the fixed asset. The next is current asset. You also need to run the business and to meet the working capital requirement. So fixed expense, we are going to purchase fixed asset, and the working capital expense you require to maintain the business. So the current asset you need to run the business, to purchase the raw material, to pay the salary, to maintain the expenses of the business maintenance expenses, and all these considered under the current asset and considered under your working capital requirement. Next is, that is for, now your business is established, business is settled, everything is done. Now you want to go for modernization. As the technological change is coming up, you have to upgrade. So modernization as well as expansion. As you are growing, you want to diversify your business. You want to go from one business to the another business. So when diversification is required, modernization is required. Have an estimate of the funds which you need for all these type of aspects. Next is for the accidental requirement. You have to count the contingent liabilities. The liability which may occur. Today it is not existing, but tomorrow there may be an accident took place in a factory, and maybe a workers, few may die or few may badly injured. You have to pay the hospitalization bill. You have to pay the compensation to the family members for the loss of a life of their family member. So here, when the contingent liability arises, the accidental requirements you have to keep in mind. So contingent liabilities are to be considered. Next is for the procurement of finance. You have to issue the equity subscription for the public. You have to issue the preference shares to the public. You are going to issue the debentures in the market. So many expenses are to be done. The application forms are to be issued, are to be circulated, brokers are to be appointed, underwriters are to be appointed, and so many administrative staff you require to handle and to monitor that subscription and the whole accounting of the shares. So again here, to procure the finance, you have to spend money. If you are going to get a public deposit, again rate of interest to be given, to the debenture rate of interest to be given, and you have to appoint the agents and the commissions to be paid to them. So all these publicity expense, printing expense, the brokerage expense, all comes under the category of procurement of finance. And every company has to meet with such expenses. So when you make the total of all these type of expense, you will end with one figure, that is suppose 50 crore rupee. So that to be called as your business finance. Bigger the business, it may not be 50 crore, it may be 5,000 crore. Even the bigger business, it may be 50,000 crore. So depends on the size of the business, the total need of the finance figure going to vary. And for the company, the finance to be accommodated like this. These are the various aspects for the business finance, and you have to acquire the finance from different angle for different purpose. So this what our content of the chapter. Each one we have to learn in detail with its meaning, character, advantage and limitations. In next class we will see the importance of business finance, and we begin with the ownership funds. Thank you.